Good morning. Welcome to Bazaar Morning Call. I'm Lata and with me Anuj and Sonia. Well, Wall Street has at least shaken off the bear grip for the moment. And the other positive for us, of course, is crude continues to remain at $60. But let me put some counters as well on the table. The dollar has been strong, which is why we didn't see the rupee gain much yesterday. Despite the crude fall, dollar index continues to go above the 97 mark. And there is a global growth worry. And you can see that not just in crude prices, but also in steel prices. So that kind of counters the positivity. The big positive for India is that Morgan Stanley statement that smart money should move from US equities to emerging market equities like India. They specifically pick out India as a positive candidate for receiving foreign funds in 2019. And we might see that good cheer continue. But we also are in the grip of our own technicals. Yesterday, for all the rally that we had, the advancers were barely ahead of decliners. The declining stocks still had the edge. As well, at around 10,700, we continue to have worries. At least elections is a worry, but much more important is the liquidity worry. As Nimesh was picking up, a lot of people point out that that's not making it very easy for people to pledge shares, raise money because of the liquidity tightness as well. So we have to put that roof on the table as well, that we are close to 10,700.
Oh, absolutely, Lata. Hi, morning. Anuj, morning. But yesterday, for the second day running, we had buying both from FIIs and DIIs, and third day from DIIs. So at least for now, there is some stability as far as, flows are concerned. So 60 crores of buying from FIIs and about 350 crores from DIIs. Also, you spoke about the roof. The floor for the market, that 20-day moving average, at least that was held yesterday at the 10,500 level or so. So the Nifty sort of holding above that level. A lot of delivery buying in banks yesterday. So 500 crores of delivery buying in ICICI Bank, 750 crores in HDFC Bank, all the marquee names. So at least some large cap buying seen there. And now that outperformance, continues by a large margin. So if you look at the month of November, MSCI India is now up 6% versus EM and Asia ex Japan up about 1.5 to 2.5%. But this morning, the SGX Nifty is under a bit of pressure. It's down about 60 odd points. So let's see which way things head. Also, Anuj, morning, this theory of the developed markets versus emerging markets, that decoupling, that continues. So yesterday we saw the Dow, which was up almost 350 points. Brent has recovered to $60 a barrel. So because the Dow is up, is it a good day perhaps to go short in this market, or will the buy on dip strategy continue? That is the basic question. But also, yesterday the consensus view was to go short, but eventually you did say that, take a long position, that will be favorable. What should the call be today?
Yeah, morning, Sonia. I think yesterday was easier. Today is tricky. Yeah. Yesterday was, for me, very easy because, the market had slipped from the 200-day moving average, had gone to 20-day moving average, and the consensus was short. So obviously, the view was that if the 20-day moving average is not breached, the market should have a rally. A normal, simple risk reward. Yesterday in closing bell, I was making this point, Sonia, to Surbhi as well. Levels are sacrosanct in a sideways market. In a ranging market, levels are sacrosanct. The levels don't have meaning in trending market like a bull market or bear market. We are not in a bull market, we're not in a bear market. We're somewhere in between. In that, you have to respect the levels. So yesterday low was 10,489. I think that yesterday's 20 DMA was 10,482. Now the 20 DMA is rising. So today's number to watch is 10,507. Again, perhaps from the risk-reward point of view, I don't know if there would be a 60-point gap down, first of all. If there is, perhaps you may just still want to see if that buy-on-dip strategy is working again. But you want to buy on dip. You don't want to chase this market. And yesterday's low of 10,490 and also the 20 DMA 10,500 perhaps is your sacrosanct stop. I think what I'll be keenly watching out for today is how the IT index moves. Because again, like we pointed out yesterday, IT index managed to bounce back. In fact, yesterday, the last bit of rally was courtesy the IT stocks. The Bank Nifty did well through the day, but IT managed to defend the 200-day moving average yesterday. The Bank Nifty still is doing well, but it's overbought. You don't want to buy a Bank Nifty after a 400-point rally. So perhaps we want to see a 120 to 180-point dip, which is one-third to half of yesterday's rally. And the Bank Nifty's 200-day moving average is 26,000. So from the risk-reward point of view, the closer you buy to 26,000, the better your risk-reward. But perhaps I would want to see if there's any kind of follow-through in, say, names like TCS, mid-cap IT. That perhaps could be a better play today compared to the banks, but then let's wait for the markets.
You have a point there, because yesterday the yield market also behaved exactly like the bank nifty behaved, overbought. What you were saying yesterday was exactly what I heard from debt market dealers yesterday. It's already overbought. So although it went to 7.67 just briefly, it ended up at 7.73 because people have enough of bonds now. So they have to circulate. You know, the NOMO has to happen. You have to create space, and only then there will be appetite to buy. And likewise, with the dollar not really crashing after the crude price, the chances of IT coming back into its own a little bit looks very much on the card. So it could be that a little bit money shifts from Nifty Bank to IT stocks just for the day. I mean, probably tactical.
Okay, well, after Morgan Stanley, HSBC has also come out with a positive call in India. We'll talk about that in greater detail. But seems like a lot of brokerages are now getting a bit more bullish on emerging markets like India. Let's take a look at what they're saying this morning, actually, to us. Harold van der Linde of HSBC has raised the India weightage from underweight to neutral. He has upgraded India. He says the key to this is that investors' holdings are very low, valuations are more reasonable, and they see continued strong earnings growth in 2019. He says as we get closer to 2019, the upcoming elections will also start to become more important.
Okay. More equity calls. Rhythm Desai of Morgan Stanley says the big fall in oil will help the macros as well as the micros. He says from a macro perspective, softer inflation, lower current account deficits, softer rates, appreciating rupee will all help. He adds, from a sectoral point of view, he sees positive implications for consumer staples, energy, aviation, OEM trucks, that is original equipment manufacturing, truck operators and telecom. Negative implications for technology and healthcare due to the INR appreciation. Okay, with that, let's come to the money market views. Bhaskar Panda of HDFC Bank says global oil prices have rallied from recent lows. As a result, he says the dollar index is down a bit. He expects the rupee to appreciate against the USD today and readjust higher. Expects USD INR pair to trade in a range between 70.75 and 70.95 today.
And on the bond market, Bhaskar Panda says that in the Indian bond market, yields have fallen on the back of rupee appreciation, global crude prices. He expects a little rally again today, and the 10-year benchmark bond yield could trade in a range of 7.7 to 7.80%.
Okay, let's talk about the global cues. Here's Mangalam with the world view.
Well, there was a pullback on Wall Street yesterday, 1.5% to about 2% gain seen on all the frontline indices after the drubbing that we saw in the previous week. So the Dow rose above 350 points, and this rise was led, of course, by all the FANG stocks. Remember, while they are in bear territory still, yesterday we saw a gain of about 1% for all Facebook, Apple, Amazon, as well as Netflix and Google parent Alphabet. One stock that really stood out was General Motors, up around 4% after the company revealed plans to cut costs and included the likes of reducing headcount as far as salaries and the staff is concerned. The two triggers that the world will be watching out for later this week, the first one, of course, is the US Fed chairman speaking. Jerome Powell will speak later this week, and then the big meeting between Donald Trump as well as Xi Jinping, which will happen at the G20 summit later this week. So those are a couple of things that will keep the street on its toes. Apart from that, across the Atlantic, we saw big gains come by in the European markets as well. A couple of triggers for that. The first one, of course, is the EU leaders backing Theresa May's Brexit deal. So that took the European markets higher. Secondly, in the Italian index, that one gained by about 3%, and that's primarily because reports suggested that the government will go ahead and cut their 2019 fiscal deficit. So that took the Italian banks higher too. Across the Asian markets, though, the sentiment hasn't percolated as much. So the Hang Seng is still in the red. The Nikkei, Kospi, as well as Shanghai, while in the green, are underperforming the sort of moves that we saw on Wall Street overnight. And the SGX Nifty indicating a cut of about 50 points. Perhaps we'll keep an eye out on how crude hovers still around that $60 per barrel mark.
Okay, well, thanks a lot for that, Mangalam. The big talking point, Trump suggesting that the US could slap the 10% tariffs on iPhones and laptops.
Yeah. Very likely is what he says.
The ones imported from China, particularly. But investors across all global asset classes have been on a roller coaster ride this year. But could relief be underway in 2019? CNBC's Michael Santoli reports.
That's the good news that's embedded perhaps in some very bad news. A lot of talk about how there have been so many ways to lose this year across asset classes in the markets. This is from Ned Davis Research. So there are 8 major asset classes. This shows how many of those 8 in each year were up at least 5% or more in that year. You can see right where we are now is 0. That's the 0.00 grade point average from Animal House that some of us remember. Now, we still have a chance for some of these to go up 5% at least in a given year. What these are is large cap U.S. stocks, small cap U.S. stocks, emerging markets, developed markets outside the U.S., as well as corporate bonds, treasuries, commodities, and real estate investment trusts. So what it really tells us is rates went up, there were fears of a slowdown, hitting equities and bonds at the same time, and then commodities also suffering from that oil crash and a lower dollar. So if there's good news, what you see from the charts is very rare to have only one or two go up in a given year, and then typically you get a bounce back. So I'm not going to predict which ones bounce back more than 5% next year, but odds are next year diversification will pay again. In other words, to own a wide variety will mean some will win while some lose.
Okay, so that's the encouragement. This is one of the worst years in terms of performance of the 8 major assets that Michael rattled out. And since it was so bad this year, will a diversified holding benefit next year is the worst behind us. He leaves that as a question, but we have one kind of an answer. This is the opinion we got from Andrew Sheets of Morgan Stanley on the road ahead for the US markets and how factors like lower crude prices and the Fed's rate trajectory will impact emerging markets like India.
We have a below consensus growth forecast for the U.S. economy next year. We have U.S. growth slowing all the way down to a 1% annualized growth rate in the third quarter. And so we think that one will reduce overall optimism towards U.S. assets, but specifically result in a pretty large deceleration in earnings growth for the S&P 500 from the current level of a 20-something% year over year for S&P earnings to just maybe 4% year over year next year. So a slower economic backdrop, weaker earnings growth, you couple that with continued tightening in the first half of next year from the Fed, and I think it's all a cocktail for a much more difficult outlook for U.S. equities relative to the rest of the world. We think the outlook in India is relatively attractive, given what's been happening with oil prices recently. We actually think the outlook in China next year could be somewhat better than low expectations currently say. We see odds that we'll see further fiscal stimulus there that will help stabilize the economy and stabilize growth. You have had an enormous repricing of EM assets, and again, the price matters. You've had a very significant derating of EM equities. You've had a very significant, even on the fixed income side, widening of credit spreads. So look, EM still has challenges. It's still going to have fundamental challenges next year, but the price is a lot better.
Okay, we have spoken a lot of business and we will speak, but here's on a personal note. It's with great sorrow we regret to inform you that veteran news journalist and managing editor of our sister channel.
Okay, CNN News 18 Radhakrishnan Nair passed away early this morning. Radha had worked with various news concerns in his 25-year-long career. He joined the TV18 group way back in 1995 with CNBC TV18, and then he moved to General News with the launch of CNN IBN in 2005. From the entire team, may his soul rest in peace.
Lata and me would personally feel a bit of a personal loss here. I joined CNBC TV18 in 2003. Radha sir, as we used to call him, everyone still refers to him as Radha sir. Taught us a lot about desk, about how to write stories, about editorial, and a lot of us owe a lot to Radha.
And for me, he was a friend. He was, of course, much senior to me. He joined in 1995. I joined in 2002. So he was already a fairly well-known face, though he was at that time producer, and then went on to become news editor. In 2005, when CNN was launched, News 18 was launched, he was taken over there in a very senior position and then went on to become managing editor. He was a source of so much energy. I mean, Radha would run from the news desk to the studio, deliver a word or two which he wants to tell the anchor, come back. There was so much energy when Radha was around.
One more good thing about him was, I remember in 2003, I was an intern, but if I had something which was different to his view, he would listen and say, okay, if there's a different view, he's always welcome, always tolerant, always willing to listen to the other side of the story. I think that's a really great quality.
In those days, we had only about 4 hours of programming on CNN.
Yes.
So the first time we did a budget together, we had to do something like a link. Nobody knew fixed income. So, I had to write out how the deficit will impact the yield curve. And Radha was like trying to make me write graphics. That was the first time we worked so intimately together. And thereafter, of course, Radha went on to see great heights. It's a very big personal loss and a professional loss.
All right, well, I did not have the privilege of working with him, but I live with these stories. So on that note, let's take a quick break. On the other side of the break, though, we'll get back to work. Our list of top 10 stocks lined up next. Hi, welcome back. Well, for now, the SGX Nifty is under a bit of pressure. I know we keep tracking the equity markets, but the other big headline is what's happening with the Bitcoin as well. Bitcoin is now down more than 80% from last year's high, and it's nearing its worst ever bear market. So we were talking about all asset classes that were under pressure this year. I think Bitcoin has by far been the worst. But our research team is standing by with CNBC TV 18's list of top 10 stocks for the day. So let's drill it down to the specifics. Anuj, what would you be looking at?
Yeah, so interesting you said Bitcoin, because it's fallen 80%, but still I think some 500 times or 800 times from last 4 or 5. A lot of people think double digit could be a decent price for Bitcoin with zero preceding. I think Jake had tweeted with zero preceding and even in that double digit. But anyway, let's talk about our market. I think I'm going a bit anti-convention today, but for me, TCS could be the stock to watch. It's corrected right up to the 200-day moving average. Very strong delivery buying yesterday, first day of buying yesterday, and this rupee strength story may have played out. And the stock has corrected quite a bit. So I would want to see the follow through here. And again, the risk reward perhaps would favor you. And SBI perhaps would be on the downside because money market reversed after 3:30. The market closed at 3:30 and PSU banks closed at the highest point yesterday. SBI led that rally. So just perhaps in the first half, that rally may cool off. That's my sense. So that's why perhaps I would want to see the view on SBI today.
Okay, well, there is a Mint newspaper report that the Reserve Bank is looking at Yes Bank's loans to NBFCs, general exposure to NBFCs, and more particularly to IL&FS and importantly DHFL and India Bulls. We have not been able to confirm the report itself, but I could get this much from my source in Reserve Bank that they were looking at the synchronized rise and fall of the three stocks. That was about all that we could get in terms of a verification of this report. But nevertheless, you must expect that if Yes Bank's loans are being watched, then the market could be a little worried about what may be the outcome of this survey.
Okay, well, Yes Bank, one of the biggest losers over the last many weeks. But what about pharma stocks? They've come back on our radar. Ekta's here to tell us more. Ekta?
Well, yes, I'll start with Sun Pharmaceuticals. That stock is in news because they have acquired a Japanese company. It's only around $1 million, but separately, it is a loss-making company with 2 facilities. Just want to add that they've also settled on a particular drug which is basically used for narcolepsy, modafinil, and it is a Ranbaxy drug. They've already taken 2 write-offs in the past 1 or 2 years with regards to this particular drug, and hence it would be a positive that they've settled on the drug finally in terms of a litigation, but we don't know what sort of write-offs would the future would entail for Sun Pharma, so maybe a little bit of trepidation there. And since there is a halal inspection going on, the stock would probably be under pressure. For Lupin, the news is that I'm picking up from my sources that the US FDA is inspecting their Mandideep facility, but over a period of time, the Mandideep facility has reduced in importance for Lupin, so just keep that stock on your radar. And separately, stocks such as Granules, which has also received a US FDA drug approval this morning, so that stock will probably be in the green because they're slowly picking up their formulation business, and hence this would bode well for them.
Okay. Thanks a lot for all those stocks. Sonal, you have some more stocks on your radar?
Hi, good morning, Lata. Well, I'll start with IFCI. The company has received a consideration of around 500 crore rupees, and that is on account of resolution of Binani Cement through the NCLT, so expect some green on that stock. Now, Bharat Ventures and the subsidiary has signed an agreement to supply power to Telangana State Grid, and the contracts, they'll be commencing from 15th of January 2019 to 30th of April 2019, and are at a net price of around 5.75 rupees per unit. Suzlon will also be in focus because they have sold some stake in the subsidiary for an amount of around 32 crore rupees. And Unichem, that one of the plants of the company has received an EIR, that is Establishment Inspection Report, and this particular plant was inspected from around 25th June 2018 to June 30th 2018. Some respite for the stock expected. Okay, thanks a lot for that, Sonal. So let's do one thing. Let's just put all of these stocks together and give you a quick recap of our top stocks to watch. Stocks with positive news flow this morning. You have TCS, IFCI, Navbharat Ventures, Suzlon Energy, Unichem Laboratories and Granules. While stocks with negative news flow this morning, SBI, Lupin, Sun Pharma and Yes Bank. But we're also going to talk about what brokerages are saying today about individual names. Anisha has that list. Hi, Anisha. Morning.
Hi, Sonia. Good morning. I'll start with Morgan Stanley. They have written a big note on metals. Now, they say that the domestic steel profitability is at a decadal peak. But on the flip side, the valuations too are at a premium to history for large steel stocks. And to add to that, the domestic demand risk continues and the high leverage also adds to the near-term concerns. Hence, they've moved around their calls on a lot of stocks. First up, they have upgraded Coal India to overweight, though they have cut their target there. They have downgraded JSW Steel to underweight from equal weight earlier. They have downgraded JSPL to equal weight from overweight earlier and have cut the target to 174 versus 314. So major cut coming in for JSPL, and for a lot of others like Hindalco, Vedanta, SAIL, they have maintained their calls, though they have cut target price for quite a few of them. Moving on to Deutsche Bank, they have written on Siemens because remember Siemens had an analyst meet yesterday. To bring in the takeaways, they say that they expect the high ROCE digital factories and building segment to lead growth. They have cut the target price and EPS marginally, but they like the fact that the valuations are very reasonable and attractive when you compare it to the historic averages. Moving on to Godrej Properties, it was in focus yesterday because they signed a JV with Hero Cycles. Now Deutsche Bank writes on it and says that the impact of this JV in the near term will be negligible. However, they maintain a buy call on the stock with a target price of 1,000. Phillip Capitals has also written on Voltas. Now they maintain a neutral call and a bit of dampener coming in here because they expect Q3 to be subdued as well. They say that the margins might continue to remain under pressure in Q3, so that adds a tad bit of negative sentiment when it comes to the consumer durable space. So that might be in focus as well. Back to you.
Okay, thank you very much for that, Anisha. This is a theme that we are going to explore further. The first one that you heard, that Morgan Stanley is worrying about the global commodity prices, steel prices, and the fact that many domestic companies are highly leveraged even as the steel price commodity cycle could be peaking off. Is it peaking off? That's a discussion we will have. But for the moment, it's a break and we will have our technical experts joining us in a minute. Ashwini Gujral, Sudarshan Sukhani and Mitesh Thakkar.
Welcome back. Well, the global cues this morning are quite interesting. Again, the SGX Nifty is down about 52 points. The rest of the Asia is quite okay. Let's see. Yesterday, of course, we had a big rally, so perhaps the market may want to digest some gains from yesterday. Ashwini Gujral, Sudarshan Sukhani and Mitesh Thakkar now join us. Good morning. Ashwini, how would you approach the index today?
Well, good morning. I think it always pays when you have unidirectional moves to go bigger, because today with this gap down, etc., I think it will be a choppy day. If you did well yesterday, I don't think there is great need to jump in today. But overall, if we get down to say 26,200 and maybe say around current levels 580, 585 on the Nifty, you can try to buy it. But today will be a much narrower day than yesterday. And I think staying with the individual stocks may be the right way to go. And this is a kind of market you'll have. One day you get a collapse and next day you get an upside, and then there is no follow through. So maybe if we get a red day where we lose 40-50 points on the Nifty, 100-150 on the Bank Nifty, that'll just kind of make things a little better.
Okay. All right, we'll remember that 10,580 and 25,200, 26,200 thereabouts as the buy on dip strategy. Well, good morning to you, Mitesh. What are you looking at in terms of levels? Is it a red day, green day?
Yeah, we'll start in red definitely. I think as the SGX is indicating. Also, is the fact that Lata, yesterday we closed very close to the upper end of the range around 10,640 mark. So maybe, the start could be weakish, but the overall setup has mildly gained strength. So I think I would not be shorting in this weakness, but maybe explore some long ideas early in the morning, especially on the stock side. On the index, I think eventually you need a breakout about 10,640 to sustain some kind of a stronger up move. So for the timing, it remains a buy on declines kind of mode, but not a 40-50 point gap, especially since you are close to the upper end of the range. But anything close to about 10,520, 530, which is what we were 2 days back, I think that will be the best levels to enter in the index.
Okay, Sudarshan Sukhani is also with us. Sudarshan, 2 good days and 2 days of buying both from FIIs and DIIs. Does this convince you that there are more upsides in this market, or do you still think that it is sort of a range-bound phase that we are in?
Yeah, good morning. Well, we have seen 2 good days. We have seen a swing yesterday, but the market, the Nifty continues to be in a range. It is at 10,600. Even a month ago, it was at 10,600. So there is a range, but because of that chaotic movement inside the range, we get a sense of activity. We are still where we were. I think the short idea that I had needs to be closed. We went short at 10,600. The markets fell yesterday but recovered. So traders who are short should close their positions. It's at break even. Now the trade is 10,500 is support and 10,750 is resistance. This 250 point range for me today is a no trade zone. So there will be intraday trades, and I'm sure traders will take it. But for me, I close my short positions and wait for these levels to be either taken out, it will take some days, or new patterns to come in the next few days. Today, I wouldn't be trading the index, Nifty, but the Nifty Bank is a different story. It's on the verge of a significant breakout. I don't know what's going on there. So if the Nifty Bank actually starts gaining over yesterday's high, there would be an intraday trade there for me. And if it continues, I would go and carry it.
Okay. Mitesh, good morning. What's your, stock-specific strategy today?
Yeah, I have 2 buys to 2 sells, Anuj. Apollo Hospital yesterday, the intraday charts gave signals of some positive expansion. So buy with a stop below 1230, look for 1295 as your short-term target. Also a buy on Axis Bank. It's a conditional buy. The breakout happens once the cash prices stabilize above 634 and it's close. It's just trading near to that. So buy above 634, keep a stop at 626 half, look for first target of 650. 2 sells. Arvind Limited is a sell. The chart structure is weakened. Here it can be sold with a stop at 314 for targets of 296. And CESC is a sell as well. The intraday charts are weak. Keep a stop at 687, look for declines to about 651 zones.
Fair enough. Ashwini, what would you be trading?
See, mainly, if you stick around with financials, you'll be better off. But I think there was a lot of consumption follow through also yesterday. So SBI is a buy with a stop of 282, target of 296. Jubilant Food is a buy with a stop of 1200, target of 1245. Apollo Hospital is a buy with a stop of 1235, target of 1290. PVR seems to be getting out of this 1500 type of zone. That's a buy with a stop of 1400, target of 1510. And ICICI Bank is a buy with a stop of 350, target of 372.
Okay, actually this whole consumption theme has come back. If you look at the month of November, stocks like Maruti Suzuki, Asian Paints, Titan, all these stocks are the biggest gainers this month, about 8 to 15 odd %.
And yesterday, HUL.
Yeah, HUL was the big gainer yesterday. But Sudarshan, you're playing this theme as well. You like a couple of names like Maruti and Asian Paints today?
Yes, some of the stocks, we are now becoming stock specific for the day because the index itself is not giving a big message. So starting with Asian Paints, and this is not about crude, it's about the fact that Asian Paints has consolidated, has made a bullish pattern and is now breaking on the upside. That's a buying opportunity. Maruti has an excellent chart. I think the correction in Maruti is over, and while there may be some choppiness, position traders could be considering buying Maruti for a longer term, and it's a trade for the day. And finally, V-Guard, that erstwhile favorite is now coming back into play. Same story, deep corrections, now trading ranges, consolidation, and an eventual breakout. So these are buying ideas, and the theme for me is to focus on stocks rather than on the index. I have 2 short sales, CEAT, which is doing nothing, and CEAT and Apollo Tyres are coming down while MRF is going up. It's a strange story in the tire industry. And Indiabulls Housing, which is now a perennial short sell.
All right. Gentlemen, we have a lot of questions for you, but for the moment, we just want to discuss kind of the stock of the day yesterday, or it's the stock of the day many days, Yes Bank. Yesterday, the big story was that three promoter entities of Yes Bank had actually issued zero-coupon bonds against the promoter's shares and raised about 1,800 crore rupees. And, you know, when the price of the shares started to fall, then the promoters, the shares held by Rana Kapoor himself, about 4.3%, was brought in addition to support those zero-coupon bonds. Now, the point is the market was not aware of it till CARE Ratings, while rating that zero-coupon bond, gave it an A- last week, and then it became public knowledge. So is this kosher, while these are not pledged shares and therefore legally don't have to be reported? Would good reporting practice require that this be put in the public domain? That's the question we are posing, and we have with us Amit Tandon, Managing Director of IIAS, the proxy investor firm, joining us on the phone line. Good morning, Amit. Thank you very much for joining us. Well, that is the simple question. Certainly, the promoter entities, Morgan Credits, Mr. Kapoor himself, and Yes Capital did not breach any rules, but it came as a sudden shock when CARE Ratings told us that zero-coupon bonds had been raised against the promoter holdings. Is that kosher, or should the promoter entities have announced it?
Lata, there are two players in this. One is the mutual funds, and the second is the promoters of Yes Bank, more specifically Rana Kapoor. In the aggregate, my belief is that the behavior of the mutual funds is far more questionable than that of Rana Kapoor. But since you've asked me about Rana, let me first come there. Certainly, it should have been disclosed. Again, while it's not specifically required, it's just in terms of additional information which is there for investors. Because it then begs the question that, look, why was this money needed? If you kind of go back and look at what promoters do, typically they do borrow money to fund their promoter's stake. In this case, all these shares were acquired many years ago and at par, so it's really not needed for that. There are of course disclosures that it was needed for the investments which the family office was doing. In which case, the question is to be asked is that, look, are there adequate checks and balances with regard to conflict of interest which have been put in place? So as of now, it's much more an issue of disclosures rather than anything else, but it could kind of move in a slightly different direction. But let's kind of pause today, and I'd say it's more a disclosure issue rather than anything else.
So Amit, morning. Since this is a disclosure issue with some of these new structures and instruments coming into play, do you think SEBI needs to revisit their regulations, get some of these structures added into their ambit?
Look, you know, the thing with markets is they're always ahead of regulations. So if SEBI were to come with this, something else will happen. My view is that if you were to ask the mutual funds what were they thinking about, that is the question they need to ask themselves, and their risk committees should ask themselves, in the sense that you're buying illiquid paper, extremely concentrated positions. I mean, both of them own virtually 100% of the paper. Now, they could turn around and say, look, regulations say that we can't have more than 15% or 10% in a particular scheme, and in that sense, they've complied with it. But I'm not sure it's there in the spirit. Finally, the question is that, look, if the structure, if there were a default, how do you enforce security? So you've got a security which can't even be enforced because it's not going to be so easy to sell promoter shares in Yes Bank if push comes to shove. So I think the bigger culprit, if I may use that word, on this is the mutual funds.
Okay. No, I believe they could not have sold it because the shares were not encumbered with them. It was only a guarantee given by the promoter entities. It was not pledged. So anyway, the mutual funds could not have sold. And therefore, your point is very well taken that the mutual funds would have been in a spot if the shares fell or for some reason they wanted to get out of that arrangement. So, just to continue with Sonia's question, do better rules need to be written with respect to mutual funds, especially debt mutual funds, and the kind of investments they should make? As you say, this is a concentrated risk.
Look, there are guidelines. My sense is that you need very severe penal action in these instances. I'm a strong believer that of having penal action. What we often do is, if there is some kind of breach, we build regulations around it rather than penalize those who we feel are responsible. Sure, you could turn around and say that, look, it doesn't breach any regulations, but let's understand how you look at this risk. And if this is how they're viewing risk, then certainly I think it's reason enough for some heads to roll in these asset management companies. I know it's a fairly strong position, but you need to remember that they're playing around with money of small investors. We're kind of saying that, look, you've got regulators, you've got RBI, you've got borrowers, and at the end of it, you've got these asset management companies themselves who are supposed to be looking after our interests. But the moment there is a crisis, there's a scramble for saying that, look, RBI needs to open up a window. If RBI is reluctant to open up a window, it's understandable given the way, if this transaction is something to go by. I would say at the very least at this stage, it would be good for the mutual funds to disclose any similar structure or where they have lent against the promoter shares in the underlying entity. Yeah. Let's begin with that as the first instance.
Fair point, Amit. Thank you very much for joining us and just alerting the investor audience to what can befall if their investments are in mutual funds. Actually, we rushed from a bank saving country to a mutual fund saving country in record time, as it were, with suddenly the investments ballooning. And probably both on the investor's side and on the mutual fund manager's side, the recognition of the responsibility is not adequate. It's not like putting your money in a bank. This is different, even if it's a liquid or a fixed income mutual fund or a debt mutual fund. The risks are very different, and therefore you need to monitor the investments that your fund is making. That's a learning which investors also have to undergo. We'll take a break on that note. They're coming back, and then we'll talk stocks more and more stocks. Meherboon Irani of Ginny Gems will be joining us with some long-term stock bets. We will also be joined by Vinod Sharma of HDFC Securities, who will give us some FNO strategies.
Hi, welcome back. We're just counting down to the pre-opening rates, about 20 more minutes to go. Let's take a quick look at what's happening with the SGX Nifty this morning. It was down about 55 points the last time we checked. It's still there. So let's see which way things head. Vinod Sharma, the head of Business Private Client Group of HDFC Securities, joins us now. Vinod, hi, good morning. If we do start with a gap down opening as the SGX is suggesting, do you think it would be good to buy on dips, and what would your targets be on the index?
I think any 55-point dip in the Nifty would be a good opportunity to begin buying, and maybe one can hope for at least around 100 points gain in the next 3 days from those levels. So I think this series, we had said in the beginning itself that this would close with a flourish, and we see that happening. Obviously, the FIs who have sold earlier are now buying back, and of course this is the first year in which, despite the FI selling, the markets have been making new highs. So we are gung-ho on the market, and we believe that the markets will still do well in December itself.
Okay, Vinod, good morning. So what are your individual stock trades?
Yeah, good morning, Anuj. I think let me talk about the Nifty stocks first, and those stocks where I'm not changing the price at which they had quoted yesterday. So ITC is one stock that we like, and I think it can be bought at the 285 call, can be bought around 3 rupees, and stop loss at 1.5, target of around 6. This is a stock in which we have seen 19% addition to open interest, and in the current series the stock hasn't moved up. In fact, it has moved down by only 1%. So apparently it would see that shorts have happened, but we believe that the stock will go up because technically the stock is well placed, and therefore the option would definitely pay off in the next 3 days. Maruti is another stock which I am buying from the Nifty, but this again is a stock in which I am making some changes. I am not buying at the open. I am buying the 7,500 call at around 80 rupees.
Mind you, this had closed at around 100 rupees yesterday. So I'm buying it at around 80 rupees. So keep a stop loss at 40 and a possible target of 150 in the current series. The next nifty stock I have is Axis Bank, and this I am buying slightly at a muted level. I am buying the 630 call at around 6 rupees. Yesterday it had closed at 815. My stop loss is 3 and a target of around 11.
Okay, Vinod, thank you very much for giving us all your trading strategies as well as your index strategies. Well, let's shift to another theme that we discussed earlier, Morgan Stanley being doubtful about global commodity steel prices and the fact that Indian steel companies are leveraged. But where is the global steel cycle and the metal cycle? Paul Bartholomew, the senior managing editor of S&P Global Platts, joins us on the phone line. Paul, good morning, and thank you very much indeed for joining us for this chat. We have seen a seminal fall in crude prices, and it's almost being rivaled by the fall in metal prices. What about crude? What about steel? Do you think it's also peaked?
Yeah, hi, good morning. I think it's taken people by surprise a bit how the market has sort of really come off strongly, probably since October. So if you look around many markets, including the US, but also China, steel prices have come off around about 15%, probably since October. India's a little bit more stable, maybe come off about 4%. But I think it's really often driven out of China, where there's been some weak economic data, some very soft consumer segments, so people don't seem to be buying as many cars and fridges and washing machines as in the past. And also, playing out in the background, you have all the sort of conflict, I guess, with the US, and that's sort of adding a bit of uncertainty in the market. And people are more reluctant to invest when they don't really know where the prices are going to head over the next few months. But I think definitely some of those factors will probably carry on into the first quarter of next year, and so I can see I can see prices sort of staying under pressure, in Q1 as well.
Steel prices will remain under pressure even in Q1. What about demand outside of China, Paul? I mean, within China as well, there's been demand softness despite the onset of winter. But outside of China, do you see the demand situation weak? And what is your estimate as we head into the next few months?
So every sort of country, I guess, has its own sort of seasonal issues and holiday issues. I think in Europe at the moment, the market's a little bit soft, and I think what sort of tends to happen is people just hold off their buying and they say, okay, we're not going to purchase now until maybe the new year. There's quite a few contract negotiations taking place. I think demand is okay in places like Europe. It's been pretty solid, but pretty strong in the US. In the US, I think we had that big price uplift after the US import tariffs kicked in, and I think there's a bit of a price correction sort of going on at the moment. But demand is pretty solid. China has been fairly good. The construction steel market, which uses about 35% of Chinese steel, is a big driver of steel. Has been pretty sort of solid. It's really, I guess, the sort of manufacturing segment that uses flat steel products has been very particularly weak. But I think there's no doubt that China will have to put a bit more stimulus into the economy, particularly around infrastructure. But I think China and India have seen some similar themes in that there's been a bit of a sort of liquidity crunch at sort of some of the sort of private and smaller ends of the market, I think. So people in tier 3 and 4 cities are finding it a bit harder to buy cars these days, to get finance. But elsewhere, I think India we still see as being pretty solid. I think the S&P global view is that steel demand will grow around about 7 to 8% over the next few years. Notwithstanding a few issues around financing.
Okay, but that would be in India. Paul, finally, I wanted to know about this multi-year cycle in metals and particularly in steel. We hear a great deal about the global growth scare. So, therefore, will there be a cap? If you were forced to give a trend for 2019, or at least the first half of 2019, would it be a very good guess that steel prices will be lower than where they are now?
Yeah, I mean, it's always difficult because China's such a sentiment-driven market. We could see like a positive G20 meeting between the leaders this week, and suddenly we might see a bit of a sort of an uplift in prices. But I don't think they would necessarily come off significantly from where we are now. But I think we could see quite a sort of flat period over the next 3 to 6 months, but certainly with a lot of price fluctuation, within that. I think, until some of this global uncertainty sort of clears up a little bit, until we see some sort of stimulus flowing through a bit more into the Chinese economy and end user segments, we could see sort of fairly flat, steel metals prices, over the next sort of 3 to 6 months.
All right, Paul, we'll leave it at that. Thanks for your quick take. So expecting flat prices over the next 3 to 6 months, but the fall has been severe. Up until now, a 15% fall in steel prices in China. That's been surprising for them. But let's get back to our own markets now. Mehrboob Irani, the MD and CEO of Ginny Gems Consultants, is here with us. Mehrboob, hi, good morning. Always great speaking with you. The consumption stocks seem to have made a big comeback. Yesterday, we saw a big move from HUL. Maruti has gained 15% this month. What's your favorite from this pack?
I think the story remains intact. Only thing which people have been questioning is about the valuations part. The management commentary as far as demand acceleration goes has been a little bit subdued on the whole part, with oil prices coming down and possibly the feel that the story will remain intact. People are looking at this sector a little bit afresh. I think my best bet, if you ask me, in this sector continues to be something called a Glaxo Consumer. I think with Horlicks up for sale, whatever price it goes for, the deal hopefully, which was supposed to be finishing by June, could happen possibly in December. Whoever buys it, the point is whatever they do to the brand, I think should turn out to be positive. So maybe post the deal, the real story for Glaxo Consumer will happen. Apart from that, in terms of relative valuations, I like Colgate.
Okay.
I think the stock made a move at last, and relative to others, it's good. As far as discretionary spending goes, I think Titan could continue to be an interesting stock, an interesting story. I personally believe that the consumption in that particular space, which Titan adheres to, also could turn out to be a little bit positive for the company and for its investors. A correction in the stock from the present price, I think, could provide a fresh buying opportunity.
Okay. Mehrboob, good morning. Your thought process on Yes Bank? Because, negative news flow, but the stock seems to be taking support at this 180 to 190 zone. I mean, is it a good value bet, you think, or perhaps there could be some more skeletons, and so you may just want to avoid it?
For reasons which quite a few of them have become obvious of late, I think this is a stock which was never favored by me. I think the only thing going in Yes Bank's favor right now is exactly, Anuj, what you mentioned right now, is that too much of damage has happened presently to the valuations. But allow me to state, when you advise a stock like Yes Bank, even at the present price, to your investor, it becomes very, very difficult to justify. You can't just say that, okay, buy the stock because most of the negatives are in the price, because every second, third, fourth day, something fresh is coming up. But at the end of it all, I do believe, and it's my personal belief, that this company ultimately could find a different bank possibly approaching it sooner or later. I have no clue on this. It's my personal gut feel. At the level at which it is, it could possibly find some suitor coming its way. And that possibly could be the single important positive trigger for Yes Bank stock. Otherwise, 180, 185, 175, 170, 190, should I just buy it for a quick trade here and there, where traders can do what they want to do? But at the end of it all, even at 185, 190, I don't see any reason to justify it on a fundamental basis, besides the fact that at one fine day, you may find a suitor coming its way.
A suitor?
Suitor means a buyer, sorry.
Yeah, I know, I get your point. I mean, an M&A is what you're expecting. Okay, yeah, that may be a bit of a wait, but yes, let's see how things pan out over there. I guess the next big event will be the CEO itself. But Mehrboob, I wanted to continue with what Sonia was asking you. A lot of people tell us that the consumption theme is going to be impacted or has already been impacted. I mean, we saw the October numbers for autos, but because of the liquidity tightness and especially NBFCs not being able to grow their book, what's your sense, therefore, for consumer durables? You spoke about Titan and other discretionaries. Is there anything that you would avoid?
In consumer?
Yes.
Well, I think most of the stocks, if you ask me in terms of valuations, I think immediate upside could possibly be limited. And considering that the overall market also, my personal feeling is over the last 25 years that I have seen the markets, I don't think that a bottom could be in place. While things have turned a little bit positive for India, certainly the disparity between US and emerging markets has come down, and that is one single factor which I was looking out for. Something tells me that the bottom may not be in place because the complete capitulation, the complete surrendering, the complete throwing in the towel, the saying that, oh, this market is not a place I want to invest. I didn't see investors doing that. And when that happens, that is the bottom for the market. So if you feel, if the investor feels, or the viewer feels that we could have one more down leg to happen, this consumption stocks possibly could also fall a little bit more. Okay. Given my preference picks, and at the present level also, I possibly can bet my money and say that ultimately investors will make money because these are great companies. But there is not too much of money to be made in the very short term, sheer because of the valuations. And also, as I mentioned earlier, the management commentary was a little bit subdued as far as incremental demand happening. And as you rightly mentioned, October was not a great month, which was a little bit contrary to what many were expecting.
Okay, the other big theme that has played out over the last 1 month is, this whole capital goods revival, right? I mean, L&T has gone from 1150 to 1400 in less than 2 months. The smaller ones as well, Siemens, ABB. What's the pick of the pack there?
I think you read my mind very well, Sonia. I think I'm quite positive on the numbers announced by most of them. ABB, even a Siemens, not bad. SKF India, Timken, you look at it and all the numbers are good. ASAB India, where there is also 90 rupees dividend announced. But the only thing which is concerning me a little bit is the valuation. They are not cheap by any standard, but they are not very dear also. So if there is a crack in the market, I think there's certainly a space to buy into, along with possibly technology or IT, which I believe has come up quite sharply. And the next down leg, I personally believe the opportunity is going to come in the space which you just mentioned and which I completely adhere to. And second is IT. I think these two sectors are worth looking at. So ABB and SKF India would be the top picks in this particular space. Despite stating that valuations at the present level could be looking a little bit stretched, but the numbers for the September quarter were brilliant, and if you have 1 or 2 more good quarters coming ahead for them, I think the stock could be at least 10, 20, 30% higher over the next 6 to 9 months.
And IT, you said?
IT, I think the way they have fallen, I think if we have the rupee strengthening a little bit more, I think I personally believe rupee is not cheap. Rupee is not cheap at 70, 71. I think possibly something has to happen for it to go back to 72, 73. But before that, if it goes to 69, we could have one more sharp down leg coming in IT stocks, which I think could be a great opportunity to buy into something like a TCS, say at around 1750, or an Emphasis or an L&T Infotech, which would be my top 3 picks in the particular space.
Okay, let's do one thing. We'll take a break on that note. We'll come back with pre-opening, and of course, we'll have some more questions for Mehboob.